It all started with a question that, well, it cuts right to the heart of the startup world.
It really does.
An offer of employee equity, specifically 1% equity, in exchange for taking a lower salary.
Yeah, the classic trade-off.
The core dilemma, right. Trading that steady, predictable income for a potential slice of the dream.
Yeah.
And the question posed was simply, what should I do?
And that question, seemingly straightforward, clearly resonated deeply within that community. It really struck a chord.
Absolutely.
What began as a query about just one offer quickly blossomed into this, wide-ranging conversation. It touched on everything from the initial, often very enticing promise of startup equity.
Right, the shiny object.
To the stark, sometimes pretty brutal realities employees face down the line. We saw perspectives on the mechanics of dilution, which we'll definitely get into.
Right.
The hidden costs, the complexities of exercising options, and even some quite pointed critiques about whether the whole system is maybe set up in a way that's inherently unfavorable to the employee.
Right. It wasn't just about the numbers in one offer letter anymore. It became this, collective sharing of experiences, of warnings almost.
Exactly. A knowledge dump from the trenches.
We're going to pull out the absolute most important nuggets of knowledge, the hard-won insights, the necessary warnings, the counterpoints, too.
Have to have those.
And the practical, actionable advice. We want to help you understand what's really happening behind the scenes with startup equity, drawing directly from the voices of people who have, been there, who've navigated these waters.
Think of this as getting the unvarnished truth, maybe the street smarts version of startup equity, distilled right from the experiences shared by people, in the trenches.
You are listening to Merge Conflicts Real Dev Talk, where passionate developers tackle code, culture, and everything in between.
We're going to begin with a particularly vivid cautionary tale shared in the sources. It really highlights the potential downsides.
Just sets the stage.
Then we'll dissect the mechanics of how that initial promise can erode over time. We'll explore the differing viewpoints on whether the system is truly fair or if it operates, as one source strongly suggests, more like a strategic disadvantage for many employees.
Which is a pretty strong claim.
It is. And finally, crucially, we'll synthesize the advice on potential guardrails, practical steps you can take, and what you absolutely need to consider if you're ever faced with a similar equity offer.
It's a journey that starts with that exciting vision of, say, 1% ownership and quickly dives into the potential reality of it becoming, as one source put it, barely a rounding error. Let's start right there with that powerful cautionary tale that seemed to really kick things off.
Okay, so the story, which seems to be echoed in, various forms throughout the thread, centers on engineers who joined a startup, motivated significantly by the equity offer rather than prioritizing, say, a competitive salary.
Right.
The specific scenario shared involves engineers who accepted salaries notably below market rates, explicitly lured by the promise of significant equity. That 1% figure mentioned in the initial query seems to be kind of a touchstone for this type of promise.
This is the classic startup pitch, isn't it? You hear it all the time.
Mm-hmm.
The founders explain the constraints on cash flow in the early days, totally understandable, and paint this compelling picture of future potential. Offer that lower salary, maybe just enough to live on.
Barely scraping by sometimes.
But compensate with what looks like a substantial piece of the pie, that 1%. The language is all about being on the ground floor, joining a rocket ship, having a real sense of ownership, unlocking massive upside when the company succeeds.
And it works, right? Because, who wouldn't want to be a part of building something big and potentially becoming a millionaire from it? It's the dream.
Exactly. The engineers, understandably, are picturing that future payout. They're thinking about what that 1% could mean down the road.
And that future payout, that slice of the dream, is precisely what makes the sacrifice of lower current income feel worthwhile, feel rational even. But as this specific cautionary tale, and frankly many others in the discussion thread vividly illustrate, the dream often encounters a harsh reality known as dilution.
Ah, yes, dilution. The silent killer of equity percentages.
You could say that. The sources detail the process by which that initial equity percentage shrinks over time, often dramatically. As the startup grows and needs more capital for product development, hiring, marketing, scaling up, you name it, it raises money through funding rounds.
Right.
These are commonly labeled Series A, Series B, Series C, and so on. In each funding round, the company issues new shares to investors, like venture capitalists or other funds, in exchange for cash.
And every single time those new shares are issued, the percentage ownership held by existing shareholders, including employees with equity, gets reduced. It gets diluted. It's simple math, but the impact can be huge.
Exactly. The pie gets bigger, but your slice gets proportionally smaller.
And the source walks us through the numbers in this specific cautionary example, painting a picture of, well, significant erosion. That initial 1% equity stake, the promise of a substantial piece,
The thing that made the pay cut acceptable
is diluted down to 0.7% after the first major funding round, the Series A, gone almost a third already.
Then, as the company continues to grow or maybe struggles and needs more cash and raises more capital in subsequent rounds, that percentage just keeps diminishing. After Series B, the 0.7% drops to 0.4%.
Wow, less than half the original promise now.
And by the time the company reaches Series C funding, that initial 1% is down to a mere 0.2%.
0.2%. That's what, an 80% reduction in your ownership percentage from what you thought you were getting?
It's a massive drop. But the dilution doesn't always stop there, and the source highlights another mechanism, the option pool expansion.
Okay, what's that?
This is when a company increases the total number of shares reserved for granting stock options or restricted stock units, RSUs, to employees, both current ones and future hires. Now, it's worth noting, one source in the discussion offers a slightly different perspective on this.
A counterpoint.
Yes, arguing that option pool expansions are typically used for equity refreshes, meaning granting additional equity to existing employees as a form of retention or reward, which sounds positive.
Okay, that sounds different.
However, other sources, and the cautionary tale itself, view it more simply as another moment where everyone's percentage of the total shares just gets smaller because the total number of shares outstanding increases. More shares exist, so your piece is smaller.
So regardless of the intent, the mathematical effect is still dilution for existing holders.
Mathematically, yes. In this particular story, after an option pool expansion on top of the Series A, B, and C dilution, that initial 1% was sliced down even further, shrinking to a meager 0.1%.
0.1%. From 1%.
The 10th of the original promise. The source's description of the feeling associated with this is palpable ownership that now barely a rounding error.
I can imagine you made sacrifices those years of below market salary, the long hours, the high pressure environment, all based on the belief you owned a meaningful chunk of the company.
Your real stake.
And suddenly that chunk is so small it feels insignificant, almost negligible against the total ownership structure.
Right.
Like, why did I even bother?
That feeling of betrayal, or at least deep disappointment, comes through strongly, and the story gets even more challenging from there.
Oh, there's more.
Yeah. After dedicating years, maybe 3 or more, according to the sources, to this intense work, some employees inevitably decide to move on for various reasons. Could be a new opportunity, burnout, life changes, anything.
Happens all the time.
This is where they often hit the lockout, a critical point highlighted in the sources. The fine print in most standard employee stock option agreements dictates a limited window to exercise those options after leaving the company.
The fine print. Always the fine print.
And the most common term, as mentioned in this cautionary tale, is just 90 days.
90 days, 3 months, to decide and act on potentially years of earned equity.
Exactly. And exercising options isn't simply, converting a promise into shares for free. You have to buy the shares at a predetermined price per share, which is called the strike price or exercise price.
Right, that's set when you get the grant, usually based on the valuation back then.
Correct. Typically set at the fair market value at the time of grant. In this specific cautionary tale, the cash required to exercise these now heavily diluted options to buy those shares at their strike price within that narrow 90-day window was a staggering $50,000.
$50,000.
Yeah.
In cash. Needed within 3 months of leaving your job.
$50,000. And critically, as you pointed out earlier, implicitly, this $50,000 is just the cost to buy the shares. It doesn't even include the potential tax implications.
Right, which, as other sources in the discussion point out, can be significant and incredibly complex. We're talking about things like alternative minimum tax, AMT.
The dreaded AMT.
Which one source refers to as AMT nightmares. This is a separate tax calculation that can kick in when you exercise certain types of options, specifically ISOs, potentially creating a huge tax bill even if you haven't sold the shares yet and can't access their value.
It's a tax on phantom income, essentially. Or you might owe regular income tax on the difference between the exercise price and the fair market value of the shares at the time of exercise for other types of options, like non-qualified stock options, NSOs.
So let me get this straight.
Yeah.
You leave your job, your steady income stops. You have 90 days to come up with, in this example, $50,000 cash just to buy the shares.
That you technically already earned through vesting.
And on top of that, You might immediately owe a potentially massive tax bill, also in cash, based on the theoretical value of those shares.
That's the potential nightmare scenario, yes. You're facing a significant cash requirement just to acquire the shares, plus a potential, possibly large, tax bill, all within a very short time frame after your salary is stopped.
Okay, I see why they called it a lockout.
The consequence described in the source for these engineers is tragically common and resonates throughout the discussion thread. Neither engineer could afford the combined cost of exercising and potentially covering the immediate tax burden. They just didn't have that kind of cash lying around, especially after leaving their job.
So what happened?
As the source recounts, their hard-earned equity vanished, reverting back to the company. Gone. Poof.
Gone. After all that work and sacrifice.
Vanished. Years of sacrifice, below market pay, intense labor based on the promise of this equity, and when push came to shove, they couldn't afford to keep it, and it amounted to absolutely nothing tangible for them. Zero.
Wow, that's rough. And that leads directly to one of the most powerful and critical arguments articulated repeatedly in the sources, doesn't it?
It really does.
The perspective that this outcome isn't a regrettable accident or just a series of unfortunate events, but rather something more fundamental. One source asserts this starkly. This wasn't a fluke. It was by design.
Yes, the phrasing used is incredibly blunt. It's not a bug, it's the business model.
Okay, that's a heavy accusation. What's the argument behind that?
The core of this argument is that the startup equity system, as it commonly operates, is structured in a way that asks employees to provide significant value through their labor, and by accepting lower salaries, but deliberately places them last in line to benefit from a successful outcome or exit.
Last in line. Who's seen as benefiting first, according to this viewpoint?
Primarily the investors and, often, the founders themselves. Investors frequently negotiate terms like liquidation preferences. The source specifically mentions 2x preferences, which means the investors get 2 times the amount of money they invested back before employees or other common shareholders see a single dime from the sale or liquidation of the company.
2 times their money back first. So if they invested $10 million, they get $20 million before anyone else sees anything.
Potentially, yes, depending on the specific terms and the exit price. Founders also often have different vesting schedules, maybe accelerated vesting upon certain events, or types of shares that can provide them with greater control or faster access to value.
So from this perspective, employees build the value, they take the hit on salary, but the capital providers have built-in protections and preferences that put them ahead in the queue.
That's the essence of the argument. Employees are often left with nothing because, as we'll discuss further, most startups don't have exits large enough to satisfy these hefty preferences and still have money left over for the common stock held by employees.
Or, as in the cautionary tale, even if there's theoretical value on paper, the employee simply can't afford the exercise cost and the associated taxes to actually own the shares before they expire.
Exactly. This perspective culminates in a really striking phrase from the source that encapsulates the feeling of betrayal and maybe misunderstanding. Equity isn't always upside. Sometimes it's a bill disguised as a bonus.
A bill disguised as a bonus. Wow.
Yeah.
That completely flips the script on how employee equity is often presented, doesn't it?
It absolutely does.
It transforms it from this potential windfall, this lottery ticket, into a potential financial obligation or even a trap.
And the comparison offered in the source highlights the perceived irrationality of it from the employee's side. Taking a market salary is like a steady, predictable income stream. Relying on equity is presented as a gamble.
Right.
As the source puts it, if you want to gamble, buy a lottery ticket. It won't cost you $50,000 to keep.
Meaning the cost to play the equity game in foregone salary over years, plus the potential $50 exercise cost, can be vastly higher than other forms of speculation, often for a much lower chance of significant return compared to, say, just investing that foregone salary in the market.
And that comparison really seemed to resonate deeply with other commenters in the discussion thread. Someone notes the financial illogic of sacrificing tens or even hundreds of thousands in salary over years and then needing another large sum in cash just for the chance that the equity might pay off someday.
Yeah, when you put it like that.
Another source reflects, this one stings because it's true. Equity feels like ownership until you read the fine print. It's the terms, the mechanics, the liquidation preferences, the exercise costs, the taxes that waterfall of who gets paid first and what it costs you that turns the perceived value into potential dust.
And it's clear this cautionary tale isn't just an isolated incident. It sounds like a common pattern, unfortunately.
Very common, based on the thread. Several commenters echoed having seen or personally experienced similar situations, dedicating years, working incredibly hard, making those financial sacrifices, and ultimately walking away with nothing, either because the company didn't exit successfully above the preference stack,
Which happens most of the time, statistically.
or because they couldn't afford to exercise within the window, or due to some other unforeseen pitfall. One commenter even shared losing $50K worth of performance bonuses that had been paid in RSUs because they left the company just before those specific grants, fully vested according to the schedule, just missed it.
Ouch. That's gotta hurt.
Yeah, the sources collectively paint a picture where, for a significant portion of employees, particularly those not in the highest executive ranks, equity ends up being effectively worthless or inaccessible. This can be due to the company outright failing, experiencing down rounds where the valuation decreases.
Making the options potentially worthless or underwater.
Right, where the strike price is higher than the current value. Or having liquidity events like an acquisition where the proceeds just aren't sufficient to cover the preferences of later stage investors, leaving absolutely nothing for common shareholders like employees.
So that's the powerful, sobering, cautionary perspective that really dominates much of the initial discussion. A lot of warnings.
A lot of warnings, yes.
But the thread wasn't just a collection of complaints or horror stories, right? There were certainly voices that offered important nuances, counterpoints, and alternative ways of looking at these dynamics. It's important we explore those as well, based on what the sources shared.
Absolutely. The intensity and bluntness of that initial post describing equity as potentially by design or a con definitely prompted some pushback and offered different framing. For instance, the characterization of this outcome as theft was explicitly challenged by one commenter.
Okay, how so?
They argued that it's not so much theft as it is capitalism, a very different lens.
That's a significant reframing. So this perspective shifts the focus from, like, a malicious system design to the inherent nature of investment and individual responsibility.
Pretty much, yeah. The argument is that founders aren't forced to take VC money on unfavorable terms, and employees aren't forced to accept equity offers. Everyone is making a choice.
So the onus is on the individual.
Therefore, according to this view, individuals should be responsible for understanding the deal they are entering into. This commenter emphasizes the need for diligence. Employees should read their contracts thoroughly, understand all the terms of the equity, and ideally get independent legal representation to advise them.
Do your homework, essentially.
Right. From this viewpoint, investors are simply acting according to the contracts everyone signed. That isn't theft, it's just the consequences of those contractual agreements playing out in a capitalistic system where capital takes risks and expects certain protections and returns.
It places the burden squarely on the individual employee to educate themselves, ask the right questions, and negotiate effectively. Be an informed participant.
Which is fair advice, but it exists in tension with the lived experiences of many others in the thread who feel they were perhaps misled, or simply weren't in a position of power to negotiate effectively, or couldn't possibly understand the incredibly complex legal documents without expensive help they might not have been able to afford.
Yeah, the information asymmetry can be huge.
For them, the feeling of being left with nothing remains very real, and the strong sentiment that equity is, quote, a con for almost everyone below a certain CXO level persists for many commenters. It's not easily dismissed just by saying, read the contract.
Okay, so that's one major counterpoint, capitalism versus theft. What about the numbers? Was there pushback on the specific dilution figures in that cautionary tale, the 1% down to 0.1%?
Yes, absolutely. One source strongly pushed back on those figures, arguing quite forcefully that the stated dilution rates 30% for Series A, 40% for B, 50% for C, and then another 50% for the option pool expansion are considerably higher than what is typical in the market for reasonably successful venture-backed startups.
Higher than normal. What did they suggest was more typical?
They cited more common ranges, suggesting something like 20-25% dilution for a Series A, maybe 15-20% for a Series B, perhaps 5-15% for a Series C, and typically 5-10% for option pool extensions, usually done between rounds, not necessarily a single massive 50% hit like in the story.
Okay, so the argument from this commenter is that, well, dilution is definitely real and significant. The initial example might represent an extreme case, maybe a company that struggled and took bad terms, rather than the average
So
scenario.
precisely. Based on their alternative calculation using those more typical market dilution rates, they estimate that an initial 1% equity grant would more likely turn into approximately 0.6% to 0.45% after several rounds of dilution, rather than shrinking all the way down to that shocking 0.1%.
Still significant dilution, but maybe not quite wiping out 90% of the initial stake.
Right. They actually called the 90% dilution figure presented in the cautionary tale total hogwash for a typical company that is performing reasonably well, which highlights a crucial point. Understanding the specific expected dilution rates for the company you're joining is vital, as they can vary wildly depending on the company's trajectory and funding strategy.
And it also brings us back to that discrepancy about option pool expansion we mentioned earlier.
Exactly. Even if it's framed as being for employee refreshes, which sounds good, the mechanism is still adding more shares to the total pool, which inherently dilutes existing shareholders' percentages, mathematically speaking. The intent might differ, but the effect is dilution.
Okay, that's a critical nuance. The rate and the cause of dilution clearly matter a lot. And it seems like the success or struggle of the company itself is deeply intertwined with how this all plays out for the employee, right?
Absolutely. Several sources connect the negative outcomes directly to company performance or lack thereof.
There was that sobering statistic mentioned.
Yes. 98.5% of startups exit below $50. That figure is just crucial because, as we discussed with liquidation preferences, for exits below a certain threshold, which varies but is often tied to the total investment amount, there's simply no money left to distribute to holders of common stock, which is what employee options convert into. The preferred shareholders take it all.
And one commenter points out that the heavy dilution and frequent, potentially less favorable funding rounds that lead to those preferences becoming so impactful often occur because the company is, frankly, poorly run and continues to lose money.
It's a tough reality. This suggests that while the system might be designed with preferences for capital, the reason employee equity often becomes worthless isn't always just because of those terms. It's frequently because the underlying business itself is struggling or failing to achieve sufficient scale or profitability to generate a large enough exit.
So the company's failure drags the equity down, regardless of the terms sometimes.
Right. The system might inherently favor investors, and terms like those high liquidation preferences or things called full ratchet agreements, which are a particularly harsh anti-dilution protection for investors, where their price per share gets reset lower if a subsequent funding round happens at a lower valuation, are described by sources as unpleasant tactics.
Definitely sounds unpleasant.
But ultimately, if the company doesn't generate enough value in an exit, there's just nothing left for anyone after the senior claims are paid, regardless of how fair or unfair the terms seem.
And yet other sources maintain that even in companies that do succeed and achieve a respectable exit, the system often inherently favors capital over labor in the actual distribution of that wealth.
That perspective persists too, yes. The point is made that VCs do play a crucial role in bringing companies to life by providing necessary funding, taking significant risk. But their primary fiduciary duty is to their limited partners, the people who invested in their fund, and maximizing their return on investment.
Not necessarily the employee's return.
Exactly. They don't necessarily factor in or prioritize the employee's small percentage return when structuring deals or managing exits. Their focus is, understandably from their perspective, on their own preference stack, their overall fund performance, getting their LPs paid back. The employee equity outcome is often secondary.
Okay. So beyond just dilution rates, company performance, and investor preferences, the sources detail a number of other significant, often unexpected pitfalls employees face that can erode the value or accessibility of their equity, turning that dream into more of a burden.
Yeah, quite a few others came up.
We've touched on the exercise cost and the potential tax bill, but it's worth emphasizing how often these seem to completely blindside employees. The sources describe the sticker price shock, when employees leave and suddenly realize they need tens of thousands, maybe more, in cold, hard cash just to buy the shares they thought they'd earned over years.
It's a huge hurdle. And as we mentioned, the tax implications can be immense and incredibly complex, far more than people realize. Those alternative minimum tax AMT nightmares are a specific concern with incentive stock options, or ISOs.
Right.
You might owe significant AMT when you exercise ISOs based on the paper, gain the difference between the strike price and the fair market value, even if you haven't sold the shares and might not be able to sell them for years, if ever. One source warns you could potentially owe hundreds of thousands in taxes on equity that could still go to zero if the company ultimately fails or exits poorly. Paying real tax on potential future nothing.
That's terrifying. Paying tax on something that might become worthless.
And the sources highlight the very real risk and apparently frequent outcome of paying that substantial amount the exercise cost, plus potentially hefty taxes to keep options that might still end up being completely worthless in the end.
Yeah.
One commenter puts it in incredibly stark terms. There's a good chance you're paying for nothing, or in other words, you're paying them to resign.
Paying them to resign. Wow, you are literally handing the company money for the right to hold on to a highly speculative asset that might never pay off.
That framing is powerful because it captures the feeling of the system extracting value from the employee, even on their way out the door. Other pitfalls mentioned include the chronic difficulty employees face in getting transparency around the company's capitalization table, the full breakdown of who owns what shares, what classes of stock exist, what preferences are in place.
Right, the infamous cap table. That lack of transparency makes it incredibly hard for an employee to truly understand where their small equity grant actually sits in the overall structure and how likely it is to yield any real value in various exit scenarios. You just don't know your true position in the equity waterfall.
Exactly. You're flying blind to some extent. And sources mention potential further dilution after an employee leaves, but before an exit occurs. The company might raise more money, further reducing that departed employee's percentage, and they have no say.
So your already small percentage could shrink even more after you're gone.
Potentially, yes. Also, the disheartening and often cited practice, though hard to prove intent, of companies strategically laying off people right before they are vested on a significant chunk of options or RSUs. It's not always the case, maybe it's just business necessity, but it does happen, allowing the company to effectively claw back valuable equity that the employee was just about to earn.
That feels particularly cynical if it's done intentionally.
It does, and as we heard earlier from that one commenter, losing performance bonuses that were paid in RSUs because the employee departed just before those specific grants had fully vested according to the schedule is another painful and apparently not uncommon outcome. The timing just kills you.
It all paints a picture of multiple layers of risk, complexity, and potential loss for the employee, stacked on top of the fundamental risks of startup success or failure and the basic dilution mechanics.
It really does. And the emotional cost is also a recurring theme in the thread. Sources describe it as heartbreaking how often this story repeats. Seeing talented, dedicated people give their best years thinking it'll pay off, only to walk away with nothing, or next to nothing after making significant sacrifices.
The collective sentiment from these sources is strong. The standard employee equity system, while it holds out that promise of asymmetric upside, is just fraught with complexities, risks, and potential disappointments that are often not fully understood by employees when they accept an offer.
That seems to be the core message coming through. Be aware. Be very aware.
So, okay, given this complex landscape and all these potential downsides and pitfalls laid out so clearly, what can an individual actually do when presented with a startup equity offer? The sources thankfully offer some very clear guardrails, strategies, and alternative ways of thinking about compensation.
Yes, thankfully it wasn't all dim and gloom. The most consistent, emphatic piece of advice running through the entire discussion thread, almost like a mantra, is take the market salary. Or, phrased slightly differently by others, get paid what you're worth in terms of your base salary.
This reinforces that fundamental lesson from the cautionary tales, doesn't it? Salary is immediate, tangible value. It covers your rent, your food, your savings, your life. You can rely on it.
It pays the bills today.
Equity, on the other hand, is repeatedly characterized as something completely different, a high-risk, long-shot upside. Its potential, its speculative value with numerous strings attached, massive uncertainties, and potentially significant costs down the line. It should absolutely not be treated as part of your baseline compensation.
Don't count on it for groceries.
Right. Don't rely on it for your daily or even yearly financial needs, or think of it as a direct substitute for a fair wage. The advice is clear. Negotiate the highest salary you can that you are comfortable living on first. Make that the priority.
And once you've prioritized getting paid fairly for your labor now, then you can evaluate the equity component as a potential bonus, maybe like a lottery ticket you might choose to accept, but never rely upon.
Eyes wide open.
Eyes wide open. Beyond prioritizing salary, a huge theme is the absolute necessity of understanding the specific terms of the equity offer you are getting. Read the fine print is mentioned multiple times, often with, strong emphasis.
Knowing the game before you play it is presented as essential self-protection. And this involves moving beyond just the headline percentage, that 1% or whatever it is,
Which can be misleading.
and asking very specific, critical questions that many employees maybe don't think to ask or perhaps feel uncomfortable asking.
Like what specifically?
Such as, exactly how many shares am I being granted? Not just the percentage. What is the strike price or exercise price I'll have to pay to buy those shares? What is the company's current valuation according to them? And more importantly, what is a realistic expected exit value for the company based on its market and trajectory?
Those are key valuation questions.
And how does the number of shares I'm getting translate into a percentage of the fully diluted shares outstanding right now? Not just the current outstanding, but including the option pool and any other commitments.
Getting the right denominator is crucial.
And crucially, what are the terms for keeping your options or shares if you leave the company? What is that post-termination exercise period? Is it the standard, and often problematic, 90 days?
That question alone is vital because it dictates the potential cash crunch you might face if you decide to leave before an exit. Knowing that upfront is critical.
Absolutely. Asking about potential future dilution rounds is also advised. How many shares are currently allocated in the option pool? What are the company's plans for future fundraising rounds?
And if possible, though often difficult, asking to see the pro forma capitalization table that's shared with investors is recommended. It's the only way to truly understand the full ownership structure and that preference stack, who gets paid before you.
That level of transparency, or maybe the lack thereof, is raised as a potential red flag by multiple sources, right? If a company's unwilling to share basic information about its equity structure,
Big red flag.
it makes it basically impossible for you to properly evaluate the offer and understand the risk you're taking.
Exactly. How can you value something if you don't know the key variables? And then, beyond just asking questions, there's the potential for negotiation. The sources suggest that certain terms can sometimes be negotiated, particularly for more senior or highly sought-after candidates who might have more leverage.
It's not guaranteed, but worth trying.
Definitely worth trying. It's presented as something you should explore.
So what specific terms are mentioned in the sources as potentially negotiable points?
The most frequently mentioned and often the most impactful negotiation point is trying to extend that post-termination exercise period. Instead of the restrictive 90 days, ask for a significantly longer term, maybe 5 years, maybe even 10 years.
10 years instead of 90 days. That's a huge difference.
Massive. One source explicitly states this is often possible on the way into a company, but not on the way out. So, negotiate it up front. A longer window gives you much more flexibility. You might see if the company has a liquidity event before you have to come up with the cash to exercise, or it just gives you much more time to save up if you do have to buy the shares. It removes that immediate pressure.
That seems like the #1 thing to try and negotiate if you can. Are there other defensive clauses mentioned?
An anti-dilution clause is mentioned, which would theoretically protect your percentage ownership from future dilution. However, the source adds the caveat that VCs often balk at giving these protections to employees, so it might be a tough ask.
Understandable, but worth knowing it exists.
Another suggestion is negotiating a buyout clause, specifically structured for a scenario where you are ever terminated without cause or effectively pushed out of the company. This could potentially ensure you receive some form of predetermined value for your vested equity rather than simply losing it or facing the exercise dilemma under duress.
Okay, so it sounds like negotiation requires significant leverage and isn't a guaranteed path to avoiding all the pitfalls, but it's certainly an important step to explore if you have the ability. Don't just accept the standard terms without asking.
Absolutely. Which leads directly to another crucial piece of advice that echoes across multiple sources. Get professional help. Don't try to navigate this alone.
Meaning lawyers and accountants.
Yes. You should have a lawyer. Review the equity documents, the offer letter, the stock option agreement, everything before you sign anything. Another source strongly advises pay the money and secure the services of a certified public accountant, specifically one who is experienced with complex employee compensation methods like stock options, RSUs, and especially the associated tax implications.
And the reason for this is pretty clear from everything we've discussed. These documents are incredibly complex legal and financial instruments, right?
Exactly. Lawyers can help you understand the detailed terms, identify hidden risks or unfavorable clauses, clarify exactly what you're signing, and advise you on potential negotiation points. CPAs are absolutely essential for navigating the potentially huge and often completely unexpected tax implications.
Like that AMT nightmare.
Precisely. Understanding AMT, the implications of making an 83B election, which is something you might do to potentially change the tax timing on restricted stock, but has its own risks and other complex tax rules, requires expert knowledge you likely don't have.
And one source makes a pretty blunt point connecting this need for professional help to your own readiness, doesn't it?
It does. The point made is, if you can't afford to pay a lawyer maybe a few $1,000s to review the offer, or if you feel pressured by the company to sign quickly without getting that review, or frankly, if nobody else credible, like professional investors, seems interested enough in the company to do deep diligence and invest on favorable terms,
Then maybe.
then maybe you're not ready for that type of startup equity risk. Either you personally can't afford the diligence required, or the deal itself might be suspect if others aren't biting or the company isn't transparent.
It fundamentally underscores that engaging with startup equity isn't just about accepting a job offer. It's a significant financial and legal transaction with potentially serious consequences that really demand expert guidance.
Well put. The sources also briefly touch on exploring alternative compensation structures that might offer employees more predictable or reliable financial upside compared to traditional, highly speculative stock options.
Oh, interesting. What are some examples mentioned in the discussion?
Employee profit-sharing plans, or EPPS, are mentioned as one potential alternative to traditional stock option plans. In these, employees receive a portion of the company's actual realized profits on a regular basis.
So tied to actual performance, not just future potential.
Exactly. Other ideas floated include structuring compensation with performance bonuses directly tied to clear, achievable metrics, offering higher commission rates for sales roles, or implementing annual or quarterly profit sharing or even revenue sharing arrangements for the team or the entire company.
These models seem designed to provide financial upside based on the company's actual realized financial performance right now, rather than relying solely on a potentially distant and highly uncertain future liquidity event like an IPO or acquisition for stock options to pay off.
That seems to be the idea. They tie employee reward more directly to the company's ongoing operational success that the employees are actively contributing to, making it feel more tangible.
And the sources also draw a distinction between stock options versus actual stock grants, right?
Yes, that came up. Stock options are explicitly defined as simply an option to buy at a price within a certain time frame. You don't own anything until you exercise and pay. Vested stock grants or issuance, like restricted stock units, RSUs, are considered by one commenter to be real compensation in a way options aren't.
Why?
Because once RSUs vest, you actually own the shares outright. You don't have to pay an exercise price to acquire them. Now, there are still tax implications upon vesting. You typically owe income tax on the value of the shares when they vest, but you don't have that separate, often large, cash outlay just to purchase them like you do with options.
Got it. So less upfront cash risk compared to options, though still complexity.
Potentially, yes.
Okay, so beyond the specific numbers, the legal terms, and the structure of the compensation itself, the sources also emphasize the importance of assessing the company culture and the people you'll be working with, especially the founders.
Yeah.
That softer side matters too.
It really does. One commenter shares that their positive experiences with employee equity, the times it did work out reasonably well, were largely due to founders who genuinely take care of the key people and prioritize treating their employees fairly.
Trust seems crucial.
Trust is cited as an absolutely foundational element for any transaction involving employee equity. If you don't trust the leadership, the complex terms and potential pitfalls become much more worrying.
This highlights that while the systemic issues and potentially unfavorable terms exist in the industry, the human element, the integrity of the leadership, can significantly impact the employee experience.
Definitely. Some founders, despite the industry norms pushing towards complex and sometimes less employee-friendly terms, genuinely build their companies with long-term alignment and transparency in mind. They view employee equity as a tool for shared success and motivation, not just leverage or a retention mechanism to be clawed back later.
Are there examples mentioned of company cultures that implement fairer structures?
Yes, a few positive examples or suggestions are mentioned, such as companies offering a $0 exercise price, effectively giving stock grants, like RSUs, instead of options that require purchase. Others provide a much longer post-termination exercise window as standard practice, like that 10-year window we discussed.
Making it easier for departing employees to realize value.
Exactly. Or even offering to help employees with the tax burden associated with equity, perhaps through loans or bonus structures, or allowing gradual exercise of options over time instead of demanding one huge payment.
So the idea is that the company culture and the values of its leadership can really dictate whether employee stock ownership plans, ESOPs, stock options, or RSU grants truly serve as a tool for genuine engagement and potential shared success.
Or if they function more like the potential trap described in those cautionary tales, full of hidden costs and complexities designed to benefit others first. Culture matters.
Ultimately, bringing it all back to that initial question from the developer, I got offered 1% equity for a pay cut, what should I do? It really comes down to a personal risk assessment and understanding your own readiness for the unique risks inherent in startup equity, as the sources repeatedly emphasize.
Yeah, it's not a one-size-fits-all answer. Startups inherently involve trading predictability and immediate stability for the potential of outsized reward. It is fundamentally risk versus reward.
You need to know yourself.
If you are fundamentally risk-averse, or if you absolutely need reliable, predictable income for your financial stability, maybe supporting a family, then a corporate gig with a steady salary and perhaps more traditional bonuses or stock plans in a public company might be a much better fit for you.
And you must understand the specific risks associated with private company startup equity, right?
Absolutely. Understand the illiquidity risk. You generally can't just sell private company shares whenever you want or need the cash. Understand the vesting period. You only earn the equity over time, typically 4 years with a 1-year cliff, and you lose any unvested portions if you leave before that. And understand your precise position in the equity waterfall, who gets paid before you in an acquisition or liquidation scenario because of those liquidation preferences.
One source provides a kind of practical framework for assessing an offer that tries to incorporate these risks, doesn't it?
Yes, it's a way to try and quantify the trade-off. Calculate the difference between the market salary for your role and the lower salary offered by the startup, and multiply that difference over the typical vesting period, say 4 years. That total amount is your direct financial sacrifice, the opportunity cost.
Okay, so that's the cost side.
Then look at the equity offered. Try to estimate its potential future value, but heavily discount it for all the risks we've discussed: the extremely high failure rate of startups, the dilution that will happen, the exercise costs, the tax implications, the liquidation preferences, wiping out common stock.
Be realistic or even pessimistic.
Very realistic. Then compare the cost of that foregone salary over those 4 years to the potential heavily discounted payout from the equity. This source suggests that, statistically speaking, based on typical startup outcomes, the total foregone salary should probably be less than 10% of the realistic expected payout from the equity for it to even potentially make financial sense, just to break even when factoring in the dismal odds.
Wow, less than 10%. That sets a very high bar for the potential equity value to justify a significant pay cut.
It does. It reflects the high risk and low probability of a massive payout. Another perspective offered in the thread is considering building a portfolio of startup experiences over your career.
Like diversifying your bets.
Kind of. The idea is that by working at several different startups over maybe 10 or 15 years, you increase your statistical odds of being at one that actually has a significant positive outcome, rather than putting all your hopes and financial sacrifices into just one single company, which is statistically likely to fail or have a small exit.
Spreading the risk across multiple lottery tickets, so to speak.
Exactly. Don't bet the farm on just one.
And circling back to that point about readiness we touched on earlier with legal help.
Yes, the sources reiterate those warning signs. If you feel pressured by the company to accept an offer quickly, if you genuinely can't afford a lawyer to review the documents properly, or if the company's equity story feels opaque, they're cagey with details, or nobody else credible, like reputable VCs, seems interested in investing on favorable terms.
Those are signals.
Those are significant warning signs, according to the sources. Maybe you, personally, or perhaps the company itself, aren't truly ready for the kind of risk and diligence involved in that type of equity arrangement. Maybe it's not the right fit or not the right time.
And finally, there was that valuation comparison to keep perspective.
Right. Use the valuation comparison provided in the sources. Ask yourself, what is more valuable to me? A, getting 1% equity at a $5 million valuation company, or B, getting 0.1% equity at a $1 billion valuation company. Your initial percentage isn't the only factor. The company's overall potential valuation matters tremendously. And remember that dilution constantly changes the denominator, your percentage of the whole.
The overwhelming synthesized advice from these sources seems crystal clear. Do not sacrifice your immediate financial stability, the money you need to live, for the dream of equity alone. Negotiate a fair market-rate salary you are comfortable with as your primary compensation. Secure your base first.
Absolutely. And if you decide to accept equity on top of that fair salary, do so with your eyes wide open, fully informed. Read every word of the fine print meticulously, understand the mechanics, how dilution really works, what the exercise costs might be, the potential tax bombs, how liquidation preferences impact you.
Ask the tough questions.
Ask direct, hard questions about the cap table, about vesting details, about future dilution plans, and critically, about what happens to your options if you leave the company. Don't be shy.
And absolutely, invest in professional legal and financial advice to guide you through the complexities. It's likely money well spent.
It could save you far more down the road.
Treat the equity as what it is. A high-risk gamble, a supplemental potential upside, but one where understanding the complex rules of the game, the true cost to play, in both foregone salary and potential cash needed to exercise, and the real, often brutal odds of success is absolutely essential.
Don't let the compelling narrative, the shiny promise of potential riches, blind you to the very real, detailed complexities and potential pitfalls that were so candidly laid out in these discussions by people who have actually experienced them.
The sources collectively make a very compelling case that while those life-changing, massive outcomes from startup equity do happen occasionally,
They do. We hear about them.
they are the statistically rare exceptions, not the rule. And the system, as it commonly operates today, often places significant burdens, complexities, and financial risks disproportionately on the shoulders of the employee who is providing the essential labor.
That conclusion seems hard to avoid based on the collective experiences shared.
So that brings us to a final thought for you, our listener, to consider, based on everything we've explored from these developer discussions. Given all the potential downsides we've talked about, the inherent complexity, the significant financial risks that seem to be transferred to the employee, and the repeated calls for more fairness and transparency highlighted in this discussion thread.
Yeah.
Should the burden of understanding and mitigating all these intricate risks fall solely and entirely on the individual employee? Is it just up to each person to become an expert in venture finance and tax law? Or does the startup ecosystem itself fit the standard practices around funding rounds, liquidation preferences, option terms, exercise windows, transparency? Does it need more fundamental systemic changes to achieve a truer alignment of interest between founders, investors, and the employees actually building the value?
That's the big question, isn't it?
Yeah. What kind of industry-wide transparency requirements, or maybe even regulatory guardrails, would actually make this system more equitable and less of a potential bill disguised as a bonus for the talented people dedicating years of their lives to building these companies?
That feels like the critical question the industry really needs to grapple with if it genuinely wants to foster long-term trust and truly shared success between capital and labor. A lot to think about there.